we'd like get an indication that we were headed it had started here. So thank you for joining DAYL's corporate law committees CLE today. Um, I'm just going to introduce our panelists real quick, and then we'll get going here. So first we have Josh Parisi. Josh represents clients in mergers and acquisitions and other complex business transactions. He advises private and public companies, private equity sponsors, and their portfolio companies, including with respect to like corporate governance and general corporate matters. Josh is a hog. He went to the University of Arkansas for undergrad and SMU Law. And then next up, we have Ashton Butcher. Ashton has such a long list of things she does, not only in this community, that y'all should just go to the Aiken website and look at it. And it's advice to young lawyers. That's a really good way to give back to the Dallas bar is to do some of the things that she's done. Um, she's a partner at Aiken. She is an expert on these issues, and she's been some of her awards are D Magazine Best Lawyer Under 40, the Deal Rising Star, Texas Young Lawyers Association Outstanding Director Award. Once again, y'all check out her firm bio and see all of her accolades. So with that, I'm going to turn it over to y'all, and let's get going.
Great. Hi, everyone. I'm Ashton Butcher, as mentioned. I started my career at Aiken. I've been here ever since, and I've recently made partner the past couple of years. Josh and I are excited to present to you all today. He and I have worked closely together ever since he started at Aiken, and are both, diehard M&A practitioners. So we are very familiar with purchase price adjustments and earnouts, and just excited to speak to you all today about them. We do have a PowerPoint presentation. We'll walk through it. To the extent that anyone has any questions, feel free to put them in the chat, and we'll try to get to them. Otherwise, we'll plan to have, if we have time at the end, we'll do a little bit of Q&A. But yeah, I'll go ahead and kick us off. Josh, if you want to go to the overview.
Sure.
So today, as mentioned, we are going to cover purchase price adjustments and earnouts. And this is just a little roadmap. As we walk through purchase price adjustments, we'll speak a little bit to the different types of adjustments, the purpose of adjustments, how the mechanics work, some drafting considerations and tips, and then ultimately dispute resolution if you can't come to an agreement on the adjustment itself. And then we'll get into earnouts, where we'll talk about the targets and milestones to get the earnout, payment of the earnout, the purpose of why you might include an earnout in your purchase agreement, potential risks and disadvantages, and other just general drafting considerations as it pertains to earnouts. So we can move on. Okay, so purchase price adjustments. What is a purchase price adjustment? A purchase price adjustment allows you to address changes to the agreed upon value of the target company or the business that you are either buying or selling. It's a mechanism by which the buyer can be assured that the target has sufficient working capital, cash, inventory, etc., to operate post-closing. Essentially, it's just there to recognize that there are certain things that are in flux that you may not be able to pinpoint exactly at closing. And if you are the buyer, you want to make sure that you're paying the right value for the business. And if you're the seller, you want to make sure that you're getting the right value for the business. So if we go to the next slide, we can kind of walk through some of the different types. So we do have a list here of different types of purchase price adjustments. I will just kind of touch on a few of the more common ones. As noted here, the most common basis for a purchase price adjustment is net working capital, which simply defined as current assets minus current liabilities, which again, we note here ensures a minimum amount of working capital after closing. So ultimately, if you're the buyer, you know that this business that you're buying needs a certain amount of working capital to actually continue to function successfully after you close the deal. And so if you end up not having sufficient working capital, you have to then infuse additional cash into the business to keep it going. You want to make sure that you are made whole for that, because essentially you've just now paid more money for the business. We do touch on the working capital adjustments kind of in more detail when we get into the mechanics, so I'll just leave it at that. Speaking of the indebtedness adjustment, You generally, for things like indebtedness and transaction expenses and other items like that, you're not going to necessarily have a target like you would have with net working capital that you're trying to pinpoint the right, numbers and be made whole for the actual value of the business. But when it comes to things like indebtedness and transaction expenses, those are things that generally the indebtedness will get paid off in connection with the closing of the transaction. And the transaction expenses, you want to have those paid at closing so that you're not worrying about that after the fact. And so if you have an indebtedness adjustment, kind of the purpose there is if you have paid off this indebtedness and something kind of unexpected comes out of the woodwork, or maybe there's a particular fee or amount of per diem additional payments that needed to be paid to fully pay off the debt. If you're the buyer, then kind of are stuck on the hook to make sure that that happens so that you're acquiring the business debt free. You want to get that money back from the seller so that you're made whole and you're not on the hook for the indebtedness liability that you had negotiated not to be liable for. Same thing with transaction expenses. Oftentimes, if you are the buyer, you want to sort of control that process so that someone's not knocking on your door post-closing looking for you to pay them for transaction expenses in connection with the closing. And so very often you'll see a transaction expense adjustment where the buyer will actually pay the transaction expenses in connection with the closing, but then the purchase price will be adjusted for the amount of those transaction expenses to, again, make the buyer whole for those payments that it's making essentially on behalf of the seller. Purchase price adjustments can be based on more than one item. You could have this whole slew of different adjustments in all these bullet points we have at the top here. But generally, you do want to be thoughtful about what types of adjustments you have and limit the different types, just to limit the number of disputes and be clear about what you're actually trying to accomplish with the adjustments. And so to that end, I would say, I walked through kind of the three most common ones. Oftentimes you will see working capital, indebtedness, and transaction expenses. Sometimes you will see some of these other adjustments, but again, you want to be thoughtful about what you're actually trying to accomplish with respect to the adjustment. You want to go to the next slide, Josh? Yep. So the purpose of a purchase price adjustment, as noted, essentially, if you're the buyer, you want to pay the correct value. You're the seller, you want to receive the correct value. You have an adjustment to essentially reflect the changes in the agreed upon value of the target company, for various changes that might happen. And as noted, you also want to make sure you have a minimum amount of working capital or cash or inventory post-closing. Purchase price adjustments generally will increase or decrease the purchase price, oftentimes on a dollar for dollar basis, but Josh will get into situations where it may not be exactly on a dollar for dollar basis. And they will be based on certain benchmarks, especially as it pertains to things like the net working capital adjustment. So, as noted here, there might be certain line items in financial statements that are agreed to, and if that line item in the financial statement ends up not being accurate, you want to true up for it after the fact. And oftentimes with things like net working capital, you will set a target dollar amount mutually agreed by the parties, sort of usually based on historical operation of the business and what that number is expected to be. And then if the number doesn't turn out to be what you expected it to be, you want to, kind of have that true up to make sure that you get the correct value. We want to go to the next slide. Purchase price adjustment mechanics. So purchase price adjustments can occur at and or after the closing of the transaction. And a lot of times the timing of the adjustment will just depend on how complicated the transaction is. Generally the more complex the transaction, you have a very strong interest in having an adjustment at the closing and then again post-closing, again, just to make sure that you are trued up and, again, I feel like I'm a broken record, but paying the right value for the business based on any changes that might occur, or anything unexpected that comes up, or any variability in net working capital. So we'll walk through the mechanics here. Mostly this kind of target concept really ties out to things that are more like net working capital. You're not going to necessarily have a target indebtedness or a target transaction expenses. Those just are amounts that exist. So for net working capital, if you do establish a target, which you generally will, that'll be mutually agreed by the parties at the time that you sign the purchase agreement. So in the purchase agreement itself, you will have a set dollar amount that is your target net working capital. This will be based on historical or projected performance. You might look back at the financial statements. The business folks will do their magic and figure out, what they think the correct number is there. And something to always keep in mind that clients just generally, know this, they're the business teams, but it's always helpful as an attorney to, put on your business cap and make sure you're pointing out to them they need to be thinking about any seasonality in the business. Some businesses, for example, a deal that I'm working on right now in the concrete and aggregates industry, they basically just go totally dead and have no business from December to March, just given that the way that they operate and where they are in the country. And so your target net working capital is going to look very different, now versus in April. So you'll want to be thinking about that. And additionally, thinking about any non-recurring extraordinary items. So as you look back into the financial statements, trying to set this target number, if there's some extremely unusual capital expenditures or extremely unusual expenses or costs, or maybe some new line of revenue comes in that's, completely out of the ordinary, you will want to be thinking about that so that you appropriately set your target. And then mechanics, you will have an estimate at the closing. It's usually prepared by the seller. There's typically no dispute resolution mechanism, although buyers can seek to cap the portion of the adjustment payable at the closing. And essentially what this is you are taking the same accounting terms that you used to determine the target. You're looking at the business as you're heading into the closing to figure out, what does this number actually look like? Here was our target. Here's where we are at the closing. At least here's where we think we are at the closing. And so that's your estimate. You will have an adjustment at the closing where you take a look at your target, you take a look at your estimate, you compare the two, and if one is higher than the other, then the purchase price will be adjusted either direction as appropriate. And then when it comes to the post-closing true-up, typically 60 to 90 days post-closing, the buyer will prepare a statement that walks through, again, using the same accounting principles, each different line item that goes into a calculation of the purchase price. So again, you have your target net working capital, you had your estimate, now you have your actual number. Now that the dust has settled, you've had 2 to 3 months that the buyer has been operating the business. You can take a look back and see what the net working capital actually was at the time. And again, you're just taking that number, comparing it to the estimate, adjusting as needed to make sure that, if money needs to flow either direction to the buyer or the seller, that again, you're paying the right value and receiving the right value for the business. You'll always want to take the time to think through the results of the adjustment calculation. So sometimes you'll have an adjustment escrow, or maybe you won't. You need to think about, which side owes the other money and what should happen to the escrow. And so something that's just very complicated when you're drafting purchase price adjustments is it is a fairly math heavy exercise, and they can get very, very complicated. And so, I always suggest that you take the time to kind of build out a few examples in Excel, or however else you choose to do your math, to make sure that your drafting accurately captures how these numbers are compared to each other and which way the cash needs to flow.
All right, so I'll walk through a couple examples of different types of purchase price adjustments, and we'll start with a very simple working capital adjustment. So we have some excerpts here from a purchase agreement that we've worked on that kind of serve as a good illustration of how this would work. But so the first kind of sentence talks about, is essentially the adjustment actual statement, where when you've determined the quote final working capital, which is going to be the result of the current assets minus current liabilities as kind of calculated in the final closing statement. Typically that's going to be in the post-closing time frame that Ashton outlined a moment ago. So once that's been determined, then if the final is greater than the estimate, which again, the estimate would be the number that the seller has delivered, typically prior to or kind of in connection with closing, then buyer will pay the seller the amount equal to the final minus the estimated. So the buyer is going to pay whatever that excess amount is. And then if the final working capital is less than the estimated working capital, then seller shall pay to buyer an amount equal to the estimated minus the final. So if the estimated is actually less than final, then in this example, the seller is going to pay buyer the amount of that shortfall. So excess and shortfall, I think, are two terms of art that typically get used in a lot of discussions around these types of adjustments. So then when even in this example, which is very simple and doesn't have a lot of the bells and whistles that you might see in a more standard purchase agreement, it's still really important to be and when you're drafting this, you should always be looking at the definitions of what is working capital, and then what are the different components, sometimes if they're defined in that definition of what they should be. So in this one, I'll kind of start with working capital and then work backwards. So working capital is total current assets minus total current liabilities as of the close of the business on the closing date. And I'll stop right there. It's really important to determine exactly when your measurement date is. This can come up in certain contexts where, if you have a business that has, potentially revenues coming in or accounts receivable or accounts payable that could be paid off in between, the time that the business opens that day and the time it closes that day, you want to make sure that you get this nailed down very specifically. In a lot of instances, you'll kind of see it tied, just generally to the closing date. And that's the way that it normally would be. So current assets minus total current liabilities as of the closing date and as of the close of business on the closing date, disregarding effects of any purchase accounting and any act or decision of buyer which occurs on or after the closing. So normally there will be, in the working capital definition, there will be the current assets minus current liabilities is the typical construct, the time that it's measured, and then you may have some very specific inclusions or exclusions from that definition. So here they've excluded purchase accounting and then acts of the buyer after that occur on or after closing. And the goal there is just to make sure that with respect to that last piece, that in the time that buyer has kind of controlled the target company or the assets, that those effects aren't calculated or aren't included in this calculation. And then the last piece here is says a copy of detailed illustration of the estimate is attached as Exhibit A. This is a common thing for parties to do, where it just helps to give a little certainty around exactly how is this calculation supposed to work. Typically, the business parties will kind of generate this ahead of time, and then the lawyers will review to make sure that it ties out to the definition that's been provided in the actual purchase document. So normally this would be in the form of an Excel spreadsheet or something along those lines that kind of lays out the specific line items that are included in current assets and current liabilities. So then for this example, current assets is accounts receivable, inventory, deposits, etc. And then again, has some specific exclusions for deferred tax assets, cash, and receivables of the target company's affiliates. And then an important piece here is that it notes that it's determined in accordance with the accounting principles. And this is important to include because, again, you want to have as much certainty as possible around exactly how are we calculating all of these items. And so typically the quote accounting principles would be a set of agreed upon guidelines that the parties are going to use to calculate these various components of current assets. So I think in most deals, that's going to end up being, US GAAP or generally accepted accounting principles as modified by whatever exclusions from GAAP the target company is using to prepare its financial statements. But that can definitely change depending on the deal. If you have a deal where the target is on an all cash basis, is not using the accrual method for accounting, then you may have to get creative as far as spelling out what the accounting principles are. And then current liabilities, it includes very similar kind of items. So I'm not going to go through that whole definition, but this is essentially, a very vanilla example of a working capital adjustment and how it would look in practice. And then for a closing, and so what I just gave a moment ago is typically what you would kind of see in the context of, I think, a post-closing adjustment. And then this is a closing adjustment example. And so this would help kind of determine what amount of cash the buyer is actually going to pay to the seller at closing. So for this one, at the closing, buyer is going to pay the seller or one of its designees. You want to make sure that typically you want to have that language in there to make sure that it's clear that seller, may have other people that are getting paid this money, including, with respect to, the indebtedness. Obviously, that's going to be paid probably directly to the lender. If there's any transaction expenses, normally that's going to be paid directly to the third-party service provider whose invoices are included there. So the buyer will pay to the seller's designees an amount equal to the base price. So that's typically going to be your top line, dollar number that was agreed, in the letter of intent or term sheet early on in the process. And then, plus the estimated net working capital adjustment. So this would be, this example assumes that you've kind of done the, comparison of estimated net working capital against a set target number. And then if that if the estimate is above that target, then it's going to be an increase. And if it's below that target, then it's going to be a decrease. And then so it'd be, adding that net working capital adjustment minus estimated closing indebtedness. Ashton already spoke about this. So this is going to be, your debt on the business. I think, most deals that we work on these days are delivered on a cash-free, debt-free basis. So you want all the debt to kind of be paid off at close, plus estimated closing cash amounts. So this one does include cash. Not every deal will have this, but in this one, the buyer is kind of agreeing that they're going to pay the seller for any cash that's on the books at closing. And then minus transaction expenses. Again, this is going to be your fees of the, seller's kind of transaction fee. So lawyers, accountants, investment bankers, etc., would be paid out here. All right. So then on the post-closing side, so you'll have a section that kind of talks about, what the definition of the final purchase price is, which is going to basically mirror the estimated, or kind of the initial purchase price definition, except it's going to be, use the final instead of estimate of each component, which just means, again, the estimate is going to be seller's estimate delivered typically prior to closing, and then the final will be the numbers that have kind of been agreed post-closing, sometimes through a dispute resolution process. So you'll have the, final purchase price, and it'll spell out exactly how that's calculated. And then the final closing adjustment will be subtracting that final or subtracting the initial purchase price from the final purchase price. And then kind of similar to the first example we went through, if the final closing adjustment is positive, which means that, your final calculated number came in above the estimate, buyer is going to pay, and then typically there will be a certain amount of time that you're allowed to do this. Buyer is going to pay that excess amount to the seller. And then if the amount is lower, or if the amount is negative in this case, then seller is going to pay that amount to buyer. All right, so there's, a number of other kind of more technical drafting considerations that go into putting together a kind of finished product purchase price adjustment. So normally the adjustment will be kind of as in the examples that we are not normally, but a very vanilla version is the examples that we just went through, where the adjustment is dollar for dollar, which just means that if there's an excess, then the buyer is paying that out, for each dollar of excess. And then if there's a shortfall, the seller is paying the buyer each dollar of the amount of that shortfall. And so there's a couple different, ways you could alter that. And I'm skipping down a little bit here, but so thresholds and collars. a threshold, or an example of a threshold would be the parties agreeing to have, that there won't be any adjustment unless the amount of variance from the final number to the estimated number exceeds a certain dollar amount. So you might say, we're going to have a $5,000 threshold on any adjustment. That's obviously would be a pretty small deal to have that size of a threshold. But then what that would mean is that if the final as compared to the estimate is only $3,000 above the estimate, then the parties are going to agree, even though the final was greater than the estimate, that there won't be any post-closing payment, or no post-closing true-up will occur. And then similarly, if there's a shortfall, but it's less than a $5,000 difference, then there won't be any payment from the seller to the buyer. Alternatively, you can use a collar, which kind of sets essentially upward bounds on how far an adjustment can go one way or the other, which is also another way of kind of saying a cap. And so, typically how this would look is, or the reason why you would do this is, the seller doesn't want to come out of pocket to pay any money back to the buyer after the deal. They'd like to keep every single dollar in their pocket if they possibly can. And the buyer also, they've already made a big investment in buying whatever, the target is. And so they don't really want to pay much more than a certain amount. And certainly depending on the type of buyer, if you're working with a fund buyer, sometimes they may actually have, capital call, or, administrative requirements that kind of make calling more dollars more difficult for them. And so what you might have is, or what you often have is an adjustment escrow, where at closing a certain amount of the purchase price is agreed to kind of be held back and typically placed with an escrow agent, and that kind of serves as a source of recovery normally for the buyer in the instance that there's a shortfall in the adjustment. And so then they can kind of go and get funds out of that escrow. And then if it turns out that the final is actually equal to the estimate, or the final is greater than the estimate, then typically that escrow would be released to the sellers, and then buyer would pay the amount of the excess. It's a deal point that's often negotiated between business parties as to whether that adjustment is, or that escrow is, kind of your sole source of recourse as the buyer. Sometimes sellers are certainly, again, they're going to want to have certainty around exactly how much they could possibly stand to lose if the estimate was way too high. And so their goal is always going to be that the adjustment escrow is the only place the buyer can look to. And, if there's such a large shortfall that it exhausts the full amount of the adjustment escrow, the buyer's not going to be able to come back to the sellers and say, pay us more money. And then, the buyer is going to say, well, it's not fair that I bought a business and the estimate was much more than, what the final amount ended up being. I should be able to come after you for more than the escrow amount. So the dollar amount of what's in the escrow can be an important part of the negotiation here as well, to determine whether or not escrow ends up being the sole source of recourse. I think I've touched on most of this. I'll go ahead and move on to the next slide, because I think we have a couple of examples. So this is an example of a threshold or a collar. So in this adjustment, there's a target amount of net working capital of $100,000. There's a lower target, which is equal to the target minus 5 million. And then there's an upper target, which is equal to the target plus $5 million. So essentially the threshold on this deal has been set at $5 million. And then the way that the estimated and the closing net working capital adjustments work is, for the estimated, is you take your estimated net working capital number, and if it's greater than the upper target, so greater than $1,005,000 or $105 million, then you would have an adjustment. And then if it's lower than $95 million, then you would have an adjustment. And then similarly at closing, then you would look at the same thing. So again, this is just a mechanism to say, hey, if there's really a de minimis amount of difference in the networking capital numbers, then we don't want to go through the hassle of having to make an adjustment, or make wires after closing. And you would typically do this in, I think we see this a lot in larger deals where their, networking capital is choppy. And, the parties have kind of agreed that you don't necessarily want to have to go through this whole process if it's just a small amount of difference.
And I would add to this that especially when you have a threshold or a collar, doing the Excel modeling with some fake numbers is really important. It can get very difficult to accurately draft it, especially if you're looking at just, probably an unusual situation, but a situation where maybe there's a big swing, maybe the seller's estimate is just totally off, and the buyer determines that the amount of working capital is just like totally different than what they were told at the closing. Because it's kind of hard to explain, but you can very easily poorly draft a provision that has a threshold or a collar that gets you to the wrong ultimate place math-wise. So again, I just am a huge proponent of, people always joke about like, I became a lawyer because I hate math. Like, sorry, if you do M&A, you got to do some math. And I very, very strongly recommend using an Excel model when you're doing something with a threshold and a collar to make sure your drafting actually works the way it's supposed to.
Yeah, absolutely. I think, with any of these adjustments that we're talking about, it's really important to make sure that the business parties have fully modeled it out, whether it's working capital or any of the other components, just to make sure that they're fully understanding, exactly what the implications are of what they'd agree to. Because you'd hate to see a client agree to have a cap on an adjustment, and then it turns out that, the estimate comes in and it's way lower than they thought. And then, they're essentially capped at, if the final is actually more, or less, then, you just hate to have that happen if the parties really weren't expecting it. So that's definitely something you always want to do. All right, there's a couple more like specific drafting tips we can talk through really quickly. So I already sort of mentioned defining the accounting principles that are used in the calculation. Again, typically this would be kind of point towards US GAAP, but then sometimes, you may have to tie it out to historical practices. Again, buyer is normally going to be the one that's pushing for a much more certain set of accounting principles. Seller may want it to be a little bit more fluid, although that can also, those roles can be reversed if buyers thinking, well, we may be able to kind of work the numbers in our favor post-closing if we don't have a very specific set of principles to work off of. So you should always just make sure that, again, the business parties are aware of exactly what they need to be looking at when these adjustments are being calculated. Be aware of the assumptions and principles used when selecting benchmarks. So this is another piece where if you have a networking capital target, you'll want to make sure that target was calculated using the same accounting principles or kind of same guiding rules as what you're using to calculate your actual numbers. Because if the target was selected one way and then the actual calculations are done a different way, you can end up with a wild result. So Ashton kind of touched on this earlier. The fewer number of items you have in a purchase price adjustment, the less likely it is that you'll have a dispute. Again, just increasing the complexity of it increases the likelihood that people will find something to pick at in the ultimate adjustment. And then, on the definitions, and I mentioned this earlier, you'll want to make sure that you've looked at all the components of what's included in a purchase price adjustment to make sure that you don't inadvertently pick up indebtedness in the calculation of current liabilities for working capital. So normally you'll see that those things are specifically excluded. And then you also want to make sure that the adjustment itself is not otherwise picked up somewhere else in the agreement, as for example as a tax liability. And then the last piece your, last two pieces is you want to make sure that you've looked at how the adjustment interplays with the indemnity provisions. So, if you have an adjustment for, an adjustment or an indemnity for transaction expenses, for example, obviously you'd like to have those, all be cleaned up at closing, but it might not be as critically important if you do have an indemnity for it. Although, your indemnity is normally going to be subject to lots of other qualifiers and limitations that might make it more difficult than just having it be adjusted at closing, where you're getting what you're getting, typically on a dollar for dollar basis at close. And then the last piece here is that, while transactions that are put together as asset sales can still include adjustments, which could include working capital, you need to make sure that you've looked at the definitions of what's included in the purchased assets, and also then the excluded assets, to make sure that they track kind of what's being transferred. And the reason why this is because you wouldn't want your working capital calculation to include compensate, an item that's actually being excluded from the deal. And so, you may not want to include, for example, if accounts receivable and accounts payable are not coming over as part of the deal, then you might not want to include those as an adjustment at closing or at all. All right, so a few points on dispute resolution. Typically the purchase agreement is going to spell out exactly how this process works. Again, the buyers, generally has a vested interest in keeping it much more simple, and not having a whole lot of rules around what can happen. The seller may want to have a very formal dispute process, so that they can make sure that, everything has kind of been agreed to before final payments are required to be made. So normally the buyer is going to provide the closing statement. Again, as Ashton mentioned, 60 to 90 days after closing. There's going to be a time period for seller to object, often 30 to 45 days from the time that they've received the closing statement. And then there will be some time, if the seller delivers an objection, there'll be some time for the parties to kind of discuss that amongst themselves. It's often 30 days before they engage an independent accountant. An independent accountant is normally going to be a firm that, an accountancy firm that neither the buyer nor the seller kind of has a pre-existing relationship with. And in the informal dispute resolution process, normally, and this would occur kind of in the 30 days period after seller has received the closing statement from the buyer. The seller is going to have the opportunity to send an objection notice. Normally that's going to have to be in writing, and it's going to have to include exactly what they're objecting to. Again, seller is going to try to negotiate for this to be able to be as general as possible. Buyer is going to say, no. If you want to object, you need to be extremely specific on exactly what you're objecting to. And then, normally a buyer is going to have some kind of obligation to provide the seller with reasonable access to books, records, sometimes even employees, although this is a point that's negotiated. And buyer is going to try to say, well, I'll give you access to those, but only during, reasonable, working hours and with advance notice, et cetera. The buyer doesn't want the operation of the business to be hampered because the seller is trying to pick and object over a $5 issue in the closing statement. Independent accountant, we kind of touched on a moment ago. You're going to want to make sure.
I'll just jump in there with like, it's not necessarily a war story, but I would just suggest that for any of y'all that work at firms, I think it's a good idea to talk to your colleagues and see who they've had good experiences with and who they haven't had good experiences with. We ended up in a purchase price adjustment dispute one time where, I think oftentimes clients will just kind of throw out a name of, hey, we don't really work with this particular accounting firm, and neither does the opposing party. We're fine with them, whatever. And then you come to find out later when you're in the midst of the actual dispute that plenty of other people within your firm have had an extremely difficult time with that particular firm, and that the firm made it a very painful process to get through the dispute. So, again, just share your knowledge and talk to people when you're, kind of not wanting to just blindly pick an independent accountant.
Yeah, completely agreed. So, normally you want to make sure it's somebody that's good and reliable, and also, somebody that's actually independent. And so, usually this will be a quick conversation between the business parties to confirm that, that neither side has actually used this firm, or if they have, that it was, far enough back in the past that we think that they can be truly unbiased in resolving disputes. They're in the purchase agreement, you can negotiate a little bit over how much authority the independent accountant has. And normally if a dispute gets submitted to them, then in typical course deals, I think the determination of the independent accountant is going to be final unless there's some kind of fraud or a manifest error. They just did the math wrong or forgot to subtract something that they really should have. And then another piece is how much are they able to review. The seller is going to be kind of interested in making sure, hey, you're only reviewing the items that we've objected to. The buyer may say, oh, I want you to be able to look at the whole entire calculation. It depends just on, the interest of the parties, and that's normally pretty transaction specific. And then, how the fees are split up. Some deals, it could just be a straight 50-50 split. If anything is submitted to the accountant, oftentimes it's going to be set up where the party that loses, kind of in proportion to like how much they were wrong, has to pay the fees of the accountant. And you might want to set it up this way as compared to a 50-50 split, because it, potentially disincentivizes people from just submitting things to the accountant if they don't really have an actual chance of winning. Because that does add time and expense to this process. All right, so a few negotiated items.
And we'll probably want to go through these quickly so we can actually make it to the earnout discussion.
Yeah, we'll run through these very quickly. So who prepares the initial statement? Again, typically this is going to be buyer. Sometimes you can provide that the seller can do that. Normally it's going to be buyer. How long the preparation and review periods are. How much access the seller or the buyer is going to get to the books and records of the other side as part of this process, what's required to be included in an objection, and then whether or not you're able to submit new objections or new items after the closing statement's kind of already gone across. The accounting firm we've already talked through, and then how much or how little the accounting firm is going to be able to review. And then a few other pieces. So what, exactly like where the accounting firm is allowed to shake out. Typically, there's going to be some language that says, the accounting firm's resolution can't be higher than the highest number proposed by the parties or lower than the lowest number proposed by the parties, because you want to keep it, within a range that the parties had already talked about, and not, some wildly different number. There could be some negotiation around the standard of review, accounting policies, and then, there's a few other items here. I think, again, probably the biggest one is just going to be the procedures, methodology and practices, that accounting principles. We kind of talked about that earlier. What's included in that is going to be really critical in negotiating this. I think that's everything on purchase price adjustments. I know there's a lot, but
yeah,
we can get ahead to the earnout piece.
Yeah, and my final 2 cents just on the dispute resolution process is, I always found that section of the purchase agreement, it was super easy for my eyes to glaze over and to feel like it's just kind of, one of the boring, kind of more boilerplate, less bespoke pieces of the agreement. And I just would highly encourage everyone to actually truly read through every sentence in, excruciating detail and think about, if there is a dispute, what does this mean for my client? Because even though it's not one of the most exciting sections of the purchase agreement, having been through a couple purchase price dispute, processes, like what you put in there really does have a very tangible impact on how that process is run. And so you do want to look at every single sentence, and as you get comments from opposing counsel, think about, what does this actually mean for my client? Because it is of critical importance. So moving into earnouts, First slide here is sort of just what is an earnout? An earnout is a contingent payment of additional consideration that's payable upon the achievement of predetermined milestones that occur after closing. So generally you'll have some negotiated targets or milestones. Sometimes it's EBITDA or revenue or, depending on the business, it could be an additional number of new customers or something of that nature. And the business either hits it or it doesn't. And depending on what happens and how the earnout is negotiated, the buyer is either required to make an additional payment or is relieved from making that additional payment. And so essentially the concept is, oftentimes this is, maybe in a business where the future of the business is a little bit less certain. Maybe it's in a startup kind of context where, there's a lot of faith in the future, but it's just there is more risk or uncertainty. And so, maybe you don't want to, as a buyer, commit to X dollars up front. But you do want to, sort of reward the sellers if the business does take off and is successful to the extent that you expect it to be. Earnouts are super, super tricky to negotiate. And again, you have to be very focused on the terms and what it actually means for the business and for your client after the fact. And we can move to the next slide, Josh. I think the next one has some kind of additional details before we get into drafting considerations. So as noted, this can be financial milestones, non-financial milestones. Oftentimes it's driven by the business parties and they're going to sort of, have a sense for what they want to negotiate as it pertains to the type of earnout. There's lots of different considerations that go into negotiating an earnout and different terms. What is the form of payment going to be? Is it just a straight cash payment? Do the founders get additional stock in the company if they if the company is successful? Are there payments for partial performance? So maybe there's different bands and thresholds where you get this much money if you hit this, you get this much money if you hit this. Is there an additional payment for performance above the goal? So let's say you hit the goal but you go way above and beyond. Does the buyer pay additional money if that happens? Are there minimums? Are there caps? Are there payment catch-ups or clawbacks? Sometimes you'll see that in the context where if there are multiple earnout payments, let's say 1 year, 2 years, 3 years post-closing, if you don't hit your target your first year, but you hit it and then some and make up for the first year, do you get both of those payments or is there no catch-up? Similarly, if you have a banner year the first year, but then the second year kind of falls off, is there an ability to claw back that earnout payment? And then just generally payment mechanics around earnouts are extremely heavily negotiated. As you can imagine, it even goes beyond purchase price adjustments. When you're talking about earnouts, it's generally a much larger payment, more of a swing. And so both parties have an extreme vested interest in making sure the mechanics are negotiated in such a way that, if you're the seller, you want to try to guarantee you're going to get that money down the road. And if you're the buyer, you want to make sure you're protected so that, you don't have to pay if things don't work out how you expect it to. So we can go to the next slide. The purpose of earnouts generally, as noted, kind of bridges the gaps between the seller's expectations as to the value of the business and the amount the buyer is willing to pay up front if maybe there's more uncertainty. If the buyer has insufficient funds to pay the full price at closing, it can be used to improve the appearance of the offer, although I don't know how successful that really is in practice. Rewards the seller for future performance while protecting the buyer from overpaying. It incentivizes managers and former owners to maintain and increase the post-closing value of the business. Incentivizes retention, et cetera, et cetera. There's lots of reasons you would have an earnout. But again, it's just very tricky because, neither party wants to, kind of fall into a trap where they are making a mistake and either overpaying or not getting paid the correct amount for the business. Guess next slide, Josh. I think that switches back to you.
Yeah, so I'd say I think this is one of the areas where you're most likely to have disputes after closing, again, because it's typically a much larger amount of money than the purchase price adjustment. It can be very, very emotional, I think, for all parties that are involved, because again, the the buyer normally does not want to make a mistake and overpay, and seller doesn't want to feel like they got cheated. And so there can be, factors, that are just out of control. COVID happened, and I think would have probably hampered a lot of different companies' ability to hit any kind of earnout, just because the economy generally just wasn't doing very well. There's going to be time and cost associated with monitoring whether or not this earnout has actually been hit after the closing. And so again, that's another piece that can be a pain point, especially if it's something that's very complex, that, the buyer is going to have to incur a lot of cost. And then potentially, the seller in checking that could also incur a lot of cost. If it's tied to post-closing services of the seller, could be considered compensation, which then could have negative tax consequences to the seller. So it's always important to have, your tax advisors or your client's tax advisors look over any earnout. And then, a few party-specific pieces. So seller-specific, stop someone from having a cleaning break. You're not just going to be able to walk away and go to the beach after this if you have an earnout. And then it could potentially put you, as a seller, you're kind of at the whim of the buyer in a certain respect, since they do, typically have control over the business. And then buyers, normally will try to have some kind of offset for indemnity claims, where if they have a claim, they can first kind of take it out of the earnout. And so that's going to be something that'll be negotiated. And then the buyer, their pain points are going to be that if the earnout includes some language around like what they can and can't do with the business after closing, that they don't like that because they want to have flexibility to do whatever they want. And then, the seller may manage target company or business to hit the target. They may kind of do things in a specific way to hit whatever the performance is. That's not actually accretive to the long-term value of the business. And so you always want to kind of make sure to watch out for that, and discuss it with your client when negotiating these. A few other drafting considerations. So business integration, making sure that, you're considering all the different synergies that are going to go in whenever the target's kind of integrated with the buyer.
And I'll jump in there too, because I've run into this as an issue before. We have seen situations where, you're, as the buyer, you're wanting to take this business that you've acquired and integrate it into your existing business maybe, or, just kind of restructure how things are done. And that gets into a very complicated negotiation around how do you actually calculate the earnout, how do you calculate the performance of the business if it's not just kind of sitting there and it's like standalone little box and it's been, lumped in with the rest of the buyer's business.
Yeah, agreed. And then, a few other items here. I think the biggest one is probably, the earnout period, how much time that's going to be, and then whether or not there's some kind of like escrow for it. The buyer's really going to push to not have this. They do not want to have to fund the money up front. But sellers may want to have it, especially if the buyer is not necessarily, it's super credit worthy. They'll want to have some kind of security. Again, there's going to be a potentially a dispute resolution process. It'll look very similar to the purchase price resolution process. So I think we can kind of skate over this one since we're close to time here. All right, I actually think that's our presentation. So I know we're
1 minute to spare.
Yeah, just about at time. But to the extent that anyone has any questions, feel free to pass them along.
Yeah, for sure. You can put the questions in the chat. Or if you have any questions after this, you can send any of us your questions and we'll make sure it gets to the right place and you get a good answer. So I'm going to take a moment here. I'm going to thank Ashton and Josh for participating today. We're all very busy and I know y'all are as well. So we appreciate y'all giving your time. If any of our attendees would like the presentation deck or a video of this CLE, we're happy to pass that along. Just let me know. The CLE credit info, the credit number is in the chat. So everyone grab that before you leave. And if you miss it or something, or you have a mistake on it, once again, I can help you out. And if anyone is interested in helping further with the DAYL Corporate Law Committee or Transaction Law Committee, please let me know. We're looking for help and we're happy to have folks get involved. So with that, everyone that can have their time and get on with their day.
All right. Thank you, Rob. Thanks,
Thank
Jerry.
you all. Take care.
Bye, everyone.